Good evening. Thank you for attending today's meeting, everybody. Please take your seats. Be comfortable. If you want any water in front of you, you can put it in front of you. Now I'm going to discuss about the US tax brackets for 2016. You may go to the taxfoundation.org for more information. So every year the IRS adjusts more than 40 tax provisions for inflation. This is done to prevent what is called bracket creep. This is the phenomenon by which people are pushed into a higher income tax bracket or have reduced value from credit or deduction due to the inflation. Instead of any increase in real income, the IRS uses the Consumer Price Index to calculate the past year's inflation and adjust income thresholds, deduction amounts, and credit values accordingly. Rather than directly adjusting last year's value for annual inflation, each provision is adjusted from a specific base year. Alright, let's look at estimated income tax brackets and rates. In 2016, the income limit for all tax brackets and all fillers will be adjusted for inflation, and it will be as follows. If you would like to look at the table 1, the top margin income tax rate of 39.6% will hit taxpayers with taxable income of $415,050 and higher for single filers, and $466,950 or higher for married filers. And the rate for 10% for 0 to 9,275 for single filers, and 0 to $18,550. I'm very sorry, for married joint filers. Head of household filers for 0 to $13,250. 15% from 9,275 to 37,650 for single filers, and 18,550 to 75,300 for married joint filers. Head of household filers will be from 13,250 to 50,400. And we go on to the 25%. And for single filers, 37,650 to 91,150. Married joint filers, 75,300 to 151,900. Head of household filers, 50,400 to $130,150. And we move on to 28 percentile. For the single filers, 91,150 to 190,150. Married joint filers, 151,900 to 231,450. Head of household filers, 130, 150 to 210 and 800. I have shortened and stopped saying the thousands. If you can imagine, it would be easier for me. Let's move on to 33 33%. I'm just like thousands everywhere. Oh my goodness. Okay, 33%. Let's move on. Single filers are 190, 150 to 413, 350. Married joint filers 231, 450 to 213, 350. Head of household filers 210, 800 to 413, 350. That's it. Now let's go to the 35%. For single filers are 413. Let's move on again. 413 and 350 to 415, 50. Okay, all right. Married joint filers 413, 350 to 466, 950. Head of household filers 413, 350 to 441,000. And the last percentile, we've made it. 39.6% for single filers are 415 and 50 plus. Married and joint filers 466, 950 plus. Head of household filers 441,000 plus. And now, standard deduction and personal exemptions. Standard deduction for single or married couples filing jointly will not increase in 2016. For taxpayers filing as head of household, it will increase by $50 to $9,250 to $9,300. The personal exemption for 2016 will be $4,050. That's it. Alright. Let's see. Standard deduction and personal exemption estimates. Alright. Filing status. Single. Deduction amount $6,300. Good. Married filing jointly $12,600. Great. Head of households $9,300. That's good. And personal exemptions $4,050. That's great. PEP and Ps. PEP and Ps are two provisions in tax code that increase taxable income for high income earners. PEP is a phase out of personal exemption, and Ps, named after the Senator Donald Pease, reduces the value of most itemized deduction once a taxpayer's suggested gross income reaches a certain amount. The income threshold for both PEP and Ps will be $259,400 for single filers and $311,300 for married filers. PEP will end at $381,900 for singles and $433,800 for married couples filing jointly, meaning these taxpayers will no longer have to have a personal exemption. Okay. 2016 Ps limitation on itemized deductions. Single $259,400. Married filing jointly $311,300. Head of household $285,350. Okay, that's great. Now, personal exemption phase out estimate. Single phase out begins at $259,400. Phase out complete at $381,900. Good. Married filing jointly $311,300 and out complete at $433,800. Head of household begin $285,350 to phase out complete at $408,850. Okay. Alternative minimum tax. Since its creation in the 1960s, the alternative minimum tax, or AMT, forced to patch the AMT by raising the exemption amount to prevent middle-class taxpayers from being hit by tax as a result of inflation. So, on January 2nd, 2013, the American Taxpayer Relief Act of 2012 indexed the income threshold for inflation, preventing the necessity for annual patch. The AMT exemption amount for 2016 is $53,900 for singles, $83,800 for married couples filing jointly. So let's see. AMT exemption estimates: single, $53,900; married filing jointly, $83,800; married filing separately, $41,900. Yes. Okay, now, and earned income tax credit. 2016's maximum earned income tax credit for singles, head of household, and joint filers is $506. If the filer has no children, the credit is $3,373 for one child, $5,572 for two children, and $6,268 for three children or more. So there are a lot of things. And income tax credit parameters for single or head of household. Income max at no children will be $6,610. With one child will be $9,920. Two children, $13,930. Three more children, $13,930. Okay. And it goes on. I suggest you go through the tables yourself. Methodology. Okay. Each tax parameter is adjusted for inflation by taking its base value from legislation and multiplying it by the current fiscal year's average customer price index, CPI, and then dividing that by the base fiscal year CPI. Each parameter is rounded to either nearest $10 or $25 or $100, depending on the specified rounding method of legislation. For example, the base value for the top 10% tax bracket for single is then $7,000. This number is multiplied by the average CPI for fiscal year 2016, which is 236.749, and then divided by the average CPI for the fiscal year 2002, which is 178.675. So the amount turns out to $9,275.18. Okay, this value then rounded to the nearest $25 yield 2016. 10% is tax bracket of $9,275. That's it. Okay. And okay, let's move on to the basic simple concept. Alright, concept of income. The taxable income is the gross income less adjustments and allowable tax deductions. Gross income for federal and most states is receipt and gains from all the sources less cost of goods sold. Gross income includes all income from whatever source and is not limited to cash received. Amount of income recognized is generally value received or which taxpayer has the right to receive. Certain types of income are specifically excluded from the gross income. The time at which gross income becomes taxable is determined under federal tax law. This may differ for some cases from accounting rules. Certain types of incomes are excluded from gross income and therefore subject to tax exemption. The exclusion differ state level. For federal income tax, interest income on state and local bond is exempt, while a few states exempt any interest in income except from municipalities with the states. Okay. In addition, certain type of receipts such as gift and inheritances, and certain type of benefits such as employer-provided health insurance are excluded from the income. So, and foreign non-resident person are taxed only on income from U.S. source or from a U.S. business. Tax on the foreign non-resident person on non-business income is at 30% of the gross income, but reduced under any tax treaties. Deductions and exemptions. The U.S. system allows reduction for taxable income for both businesses and some non-business expenditures called deductions. Businesses selling goods reduce their gross income directly from the cost of goods sold. In addition, businesses may deduct most type of expenses incurred in the business. Some of these deductions are subject to limitations. For example, only 50% of the amount of incurred any meals or entertainment may be deducted. The amount and timing of deduction of business expense is determined under the taxpayer's account period, which may differ from method used in accounting records. Some type of business expense are deductible over a period of year rather than when incurred. These include cost of long-lived assets such as building and equipment. Cost of such asset is recovered through deduction of depreciation or amortization. In addition to the business expense, individuals may reduce income by allowance for personal exemptions and in either fixed standard deduction or itemized deduction. One personal exemption is allowed per taxpayer, and additional such deductions are allowed for each child or certain other individuals supported by the taxpayer. The standard deduction amount varies by taxpayer filing status. Itemized deduction by individual include home mortgage interest, property taxes, certain other taxes, contribution to recognized charities, medical expense in excess of 7.5% of adjusted gross income, and certain other amounts. Personal exemptions and the standard deduction and itemized deduction are limited, phased out above a certain income level. Okay, let's look into some of the business entities, shall we? And corporations must pay tax on their taxable income independently of their shareholders. Shareholders are subject to tax on dividends received from the corporations. By contrast, partnerships are not subject to income tax, but their partners calculate their taxes by including their shares or partnership items. Corporations owned entirely by U.S. citizen or residents as corporations may elect to be treated similarly to a partnership. A limited liability company and a certain other business entities may elect to be treated as corporations or as a partnership. States generally show such characterization. Many states allow corporations to elect as corporation status, and charitable organizations are subject to tax on business income. Certain transactions of business entities are not subject to tax. These include many types of formation or reorganization. And let's look at some of the credits, tax credit. Just a second. All right. Let's look at the tax credits. A wide variety of tax credit may reduce income tax at the federal and state level. Some credits are available only to individuals, such as child tax credit for each dependent child, American opportunity tax credit for education expense, or earned income tax credit for low-income wage earners. Some credits, such as work opportunity tax credit, are available to businesses, including various special industry incentives. A few credits, such as foreign tax credit, are available to all types of taxpayers. Payment or withholding tax. Let's look at some withholding tax now. Okay. The United States federal and state income tax systems are self-assessment systems. Taxpayers must declare and pay tax without assessment by the taxing authority, and quarterly payment of tax estimate to be due are required to the extent that the tax are not paid through withholdings. Employers must withhold income tax as well as Social Security and Medicare tax from wage. Amount to be withheld are computed by the employers based on the representation of tax status by employee on Form W4 with limited government review. State variations. 43 states and many localities in the U.S. Impose an income tax on individuals. 47 states and many localities impose tax on the income of corporations. Tax rates vary by the states and locality, and many fixed and graduated. Most rates are the same for all type of incomes. State and local income taxes are imposed on addition to federal income tax. State income tax is allowed as deduction in computing federal income tax, subject to limitations for individuals. State and local taxable income is determined under the state law and often is based on federal taxable income. Most states conform to many federal concepts and definitions, including defining the income and business deductions and timing thereof. State rules vary widely with regard to individual itemized deductions. Most states do not allow deduction for state income tax for individuals and corporations, and impose tax on certain types of income except for at the federal level. Some states have alternative measures of taxable income and alternative taxes, especially for the corporations. And states imposing an income tax generally tax all income of corporations organized in the states and individuals residing in the states. Taxpayers from another state are subjected to tax only on income earned in the state or apportioned to the state. Businesses are subject to income tax in the state only if they have sufficient nexus on connection to the state. Non-residents. Let's look at some non-residents. Foreign individuals and corporations not resident in the United States are subject to federal income tax only on income from a U.S. business and certain types of income from U.S. sources. They are subject to a different transfer tax, estate or gift taxes regime than a U.S. taxpayer. State tax individuals resident outside the state and corporations organized outside the state only on wages or business income within the state. Payer of some types of income to the non-resident must withhold federal or state federal withholding of 30% on such income may be reduced under a tax treaty. Such treaties do not apply to the state taxes. That would only be the withholding tax. Okay. Let's look at the capital gain tax. Individuals and corporations pay U.S. federal income tax on the net total of their capital gains. The tax rate depends on both the investor's tax bracket and the amount of time the investment was held. Short-term capital gains are taxed at the investor's ordinary income tax rate and are defined as investment held for a year or less before being sold. Long-term capital gains on the disposition of tax held for more than 1 year, and it's taxed at a lower rate. Let's look at some payroll taxes. In the United States, payroll taxes are assessed by the federal government. Many states, the District of Columbia, and numerous cities. These taxes are imposed on employers and employee and on various compensation bases. They are collected and paid to the taxing jurisdiction by employers. Okay. Most jurisdictions imposing payroll tax require reporting quarterly and annually in most cases, and electronic reporting is generally required for all but small employers, because a payroll tax are imposed only on wages and not on income from investment. Tax on labor income are much heavier than tax on income from capital. Income tax withholding. Let's look at some withholding tax for income. Federal, state, and local withholding taxes are required in those jurisdictions imposing in income tax. Employers having contact with jurisdiction must withhold the tax from wages paid to the employees in those jurisdictions. Computation of the amount of tax to withholding is performed by the employer based on the representation of employee regarding his or her tax status on the IRS Form W-4. So withheld must be paid to the taxing jurisdiction and are available as refundable tax credit to the employees. Income taxes withheld from payroll are not final taxes, merely prepayments. Employees must still file income tax returns and self-assessed tax, claiming amount withheld as payments. Let's look at some Social Security, Medicare taxes. Okay. Federal social insurance taxes are imposed equally on employers and employees, consisting of a tax of 6.2% of wages to an annual wage, maximum $118,500 in 2015 for Social Security, plus a tax of 1.45% of total wages for Medicare. In 2011, employees' contribution was reduced to 4.2%, while the employer's portion remained at 6.2%. To the extent an employee's portion of the 6.2 tax exceeds the maximum by reason of multiple employers, each of whom will collect up to an annual wage maximum, the employee is entitled to a refundable tax credit upon filing an income tax return for the year. Let's look at some unemployment taxes. employers are subject to unemployment taxes by federal and all state government. The tax is a percentage of taxable wages with a cap. The tax rate and cap will vary by jurisdiction and by employer's industry and experience rating. In 2009, the typical maximum tax per employee was under 1,000. Some states also impose unemployment, disability insurance, and or similar taxes on employees. Let's look at some reporting and payments. Employers must report payroll taxes to their appropriate taxing jurisdiction in the manner each jurisdiction provides. Quarterly reporting of aggregate income tax withholding and social security taxes is required in most jurisdictions. Employers must file reports of aggregate unemployment tax quarterly and annually with each applicable state and annually at federal level. Each employer is required to provide each employee an annual report on IRS Form W-2 of wages paid and federal, state, and local taxes withheld, with a copy sent to IRS and the taxation authority of the state. These are due by January 31st and February 28th, March 31st if filed electronically, respectively, following the calendar year in which wages are paid. The Form W-2 constitutes proof of payment of tax for employee. Employers are required to pay payroll tax to the taxing jurisdiction under varying rules, in many cases within one banking day. Payment of federal and many state payroll taxes required to be made by electronic fund transfer. If certain dollar thresholds are met, or by deposit with bank for the benefit of taxing jurisdiction. Let's look at some penalties. Okay. Failure to timely and properly pay federal payroll tax results in an automatic penalty of 2% to 10%. Similar state and local penalties will apply. Failure to properly file monthly or quarterly returns may result in additional penalties. Failure to file Form W-2 result in an automatic penalty up to $50 per form not timely filled. State and local penalties vary by jurisdiction. A particularly severe penalty applies where a federal income tax withholding and social security tax are not paid to the IRS. The penalty up to 100% of the amount not paid can be assessed against the employer's entity as well as any person, such as a corporate officer, having control or custody of the fund from which payment should have been made. Okay, today's discussion will end now. Thank you for everybody who has joined me in this meeting. If you would like to have more meetings such as this, would you like to comment on the section below? Thank you and